Hello, everybody. Welcome to Evangeline Academy. Today, we are going to learn about Statement of Financial Position, Unit 5.4, IGCSE Business Studies O-Level. Introduction. While the income statement measures the business's profitability over a year, the Statement of Financial Position or balance sheet provides a snapshot of the business's work at a single point in time. It shows what the business owns, what the business owes, and how the business is financed. What are the main elements of a statement of financial position? Let's understand what is a statement of financial position. It is also known as the balance sheet. It has lists and gives value to all assets and liabilities of a business. This shows how much wealth the owners have invested. And the formula to calculate the owner's equity is total assets minus total liabilities. What are assets? Assets are items of value owned by the business. There are two types of assets: non-current assets, which are called fixed assets, and current assets. The examples of assets are land, buildings, machinery, vehicles, cash, inventories, debtors, etc. What are non-current assets? These are used by the business for a long period, more than a year. It provides benefits for many years and depreciates over time. Examples are buildings, vehicles, and equipments. Intangible assets are assets that you cannot touch, like brand names, patents, and copyrights. What are current assets? These are short-term assets used or converted into cash within 1 year. The examples of current assets are cash, inventories, accounts receivable, etc. What are liabilities? Liabilities are amounts owed by the business to others. There are two types of liabilities: non-current liabilities and current liabilities. What are non-current liabilities? These are long-term borrowings not repaid within a year. Examples are bank loans, debentures, like long-term bonds. What are current liabilities? These are short-term debts that must be repaid within 1 year. Examples: bank overdraft, accounts payable, etc. What is owner's funds or shareholders' equity? Shareholders' equity is the total sum of money invested into the business by the shareholders or owners. It includes share capital, money raised by selling shares, reserves, that is, retained profits from previous years. Why is this important? Because it shows the financial strength of a business. It helps owners how much wealth they own. And the financial statement must always balance total assets equals total liabilities plus equity. Interpret a simple statement of financial position and make deductions from it. Let us understand how shareholders can use the financial statements and what they can analyze about the business. They can analyze if their stake in the business has increased or decreased by comparing total equity over 2 years, how the business expansion was financed by increasing non-current liabilities from retained profits or by selling new shares. What is a working capital? Working capital equals current assets minus current liabilities. It represents funds available for day-to-day operations. A business cannot survive without working capital. This is used to pay short-term debts. If working capital is too low, creditors may force the business to stop trading. What is capital employed? It is the total long-term and permanent capital used by business assets. Capital employed equals shareholders' funds plus non-current liabilities. It includes share capital, money issued from shares, reserves, retained profits, shows how the business is financed overall. Why we interpret a statement of financial position. Number one, to understand what assets the business owns. The asset section shows where the money has gone. Is it in buying non-current assets like long-term investments such as buildings and machines? Or is it in buying current assets such as cash, inventory, and receivables, which shows the short-term strength or liquidity? If current assets are too high, maybe too much stock is unsold or cash is idle. Number two, it interprets how the business finances its assets. The liabilities and capital section shows where the money came from. The business can finance its operations in three ways. Number one, shareholders' equity, otherwise called as the owner's money, which you get by selling shares or using retained profit. Number two, by getting a long-term debt or non-current liabilities like bank loans. And number three, short-term debt like current liabilities by borrowing from creditors or getting bank overdrafts. If long-term loans increase, the business depends more on debt. If owner's capital increases, business is becoming stronger and more self-reliant. Number three, financial stability. Comparing total assets and total liabilities shows how secure the business is. If assets are more than liabilities, business is stable. If liabilities are too high, financial risk increases. Number four, what is working capital? It is current assets minus current liabilities. Hence, the statement of financial position tells if the business can pay short-term debts. If it is a low working capital, it means the business has liquidity problem. If it is a high working capital, maybe insufficient, inefficient use of money, too much tied up in stock or debtors. For example, if current assets is $50,000 and current liabilities is $40,000, working capital equals 10,000. It's okay, but not too strong. Number five, capital employed, which is shareholders' funds plus non-current liabilities. It tells us the total long-term finance used to buy assets. It helps to check the efficiency, how well the business is using the money it invested. Why we interpret the statement of financial position. Example interpretation. If both non-current assets and loans rise, it means the business expanded using borrowed funds. If working capital falls, possible liquidity issue. So every change in figures tells a story. Why we interpret the statements of financial position. Non-current assets increased. The business bought new machinery or expanded. Non-current liabilities increased. Expansion was financed by long-term loans and not by shareholders. Working capital fell from 10,000 to 0. Liquidity is poor. Short-term finance may be risky. Equity fell. The shareholders' value has decreased. So financial position tells you not just what's there, but how and why the business is changing. Number seven, why does the statement of financial position matter? It helps all users of accounts, like the shareholders, to check profitability and safety of their investment, managers to plan the future finance and operations, creditors and banks to judge if it's safe to lend money. Example interpretation. The statement shows current assets of $50,000 and current liabilities of $30,000. Non-current liabilities increased from $40,000 to $60,000 this year. What is the working capital? And how is the business financing its expansion? Think the answer. Working capital is current assets minus current liabilities. Current assets are 50,000 minus current liabilities is 30,000. Hence, the working capital is 20,000. Second question. How is the business financing its expansion? Expansion is financed by long-term loans.